Why would I buy property when REITs is giving like 5-6% returns?
Hello everybody, my name is Ivan.
And I'm Sean.
And today we are going to be talking about
Capital appreciation. And we are basically the co-founders of Quadrant. So capital appreciation is just one of the 3 profits that we're going to cover in this particular series.
So what exactly is capital appreciation? If you are buying a property at $1 million and we make $125,000 over a period of 5 years, right? This means that it's actually a 12.5% gain over 5 years. So on a per year basis, right, it is 2.5%. And to be frank, right, at 2.5%, it's not worth buying.
And I think that's one of the biggest misconceptions, because the key here is that if it's only 2.5% returns, I would, hey guys, bro, I would never like buy property. Why would I buy property when REITs is giving like 5-6% returns?
REITs is much more liquid.
Yeah, it's way more liquid, right? And what's the key factor over here is that we are able to get a bank loan. And therefore, if we only put in $250,000, which is 25% down payment, right, at a capital appreciation of 125k over 5 years, this means that we actually make a 50% return on our money, all right? Yes, guys, I know what you're thinking. I'm just excluding out all expenses, everything, to really make a point here, all right? But basically, we get a 10% per year return just based on capital appreciation.
Yeah, so this makes property investment interesting.
So this is basically what we call the multiplier effect when it comes to leverage. Of course, the more you can basically borrow, let's say assuming we can get like a 80% loan, alright, which means you only put 20% down payment, right? Do remember this is that we now use lesser money to earn more, alright, in terms of percentage when it comes to capital appreciation.
So these effects of our capital appreciation, right, and sufficient capital appreciation, right, comes about as an effect of leverage. So leverage is actually a double-edged sword. So if done right, you will exponentially grow your wealth, and if done wrongly, it will go the other way.
So now that we know what is capital appreciation, I just really want to find out, bro, what causes capital appreciation?
Yeah, so number one thing, right, is the effect of rising land prices. You see, in Singapore, right, as there is more and more land release, right, our government may price the land higher and higher. And because of this, right, this brings about the rising prices of properties in the whole area.
Oh, so does it mean that if I were to buy a property today, and 3 years later, the government sold the land at a higher price, right? And does it mean that I'm going to have a capital appreciation?
Yeah, so what happens is that if the government sells the neighboring land at a higher price, your property price will likely go up too. The reason being that if your next door is like selling at so high a price, people will be willing to fork out a higher price for your property too.
And that's exactly right. If I had bought my property at $700,000 and my neighbor bought it at $1 million, it's only justifiable that I will want to sell it as close to $1 million as possible.
That is exactly right. So this is what is happening in the market today. Another factor that affects capital appreciation is actually inflation.
Inflation basically happens when more money enters into the market, and therefore your $1 today will just become less valuable in the future. But one thing for sure is that a home will still stay a home, and therefore the value still remains. Thus, there will be a natural form of capital appreciation by hedging against inflation.
There are 3 ways to outbid the market, and the methods are:
subscribe, like, and comment on our videos. But in all seriousness, right, I think there are basically 2 ways.
Okay, yeah. So the number 1 way, right, is to actually buy in growth areas. So when we are talking about Singapore, right, there are places that are growing that has like, where we are talking about like Jurong Lake District, it's going to be like the second CBD of Singapore, and there will be more and more demand. Buying in this kind of areas, right, will likely give you the potential capital appreciation.
And the second way is actually to buy something at under market value. So assuming we are buying in a resale market and the bank gives a value of $1 million, if you manage to buy it at $900,000, you roughly know that you're going to make $100,000 or more, all right, in the distant future.
So these are the 2 ways, right, that we can create the potential capital appreciation for our property purchases. Hey Sean, at what point do you consider a property an asset or a liability?
I mean, now most of the time we have this thing called cost of housing, and most of the cost is actually on interest. Therefore, if we are able to get a capital appreciation higher than your cost, which is your interest, I would say that you're going to profit off this particular property when you sell in the future. And therefore, in cases like that, I will classify it as an asset.
Yeah, assets are properties, right, or things that actually feed us instead of eat at us. So this is why, right, we always want to be buying properties, right, that is in growth areas, or like buying properties on the resale market at an undervalued price.
So where you want to be at is to buy a property that not only hedge against inflation, but to also ensure that you are in a growth area such that capital appreciation will be higher than the interest that you will pay.
I hope you guys learned something from this section today. If you did, click on the like and subscribe button.
And this is 1 out of 3 profits when it comes to property investing, and we look forward to seeing you in our next videos. Bye.